As the housing market in many parts of Canada continues to remain strong, many Canadians are considering investing in real estate to diversify their investment portfolios. While there are plenty of advantages to investing in real estate, it's essential to understand the tax implications involved. I will outline the key tax considerations you need to be aware of before investing in real estate in Canada. I'll explore the taxes you'll be subject to as a property owner, strategies for maximizing your tax savings, and tax implications for non-residents who are investing in Canadian properties. When investing in real estate in Canada, you'll be subject to several different types of taxes. It's crucial to factor these into your financial calculations and investment strategy. Income tax. Rental income generated from your investment property is subject to income tax. The amount of tax will depend on your income and which tax bracket you fall into. You will need to report your rental income when filing your annual income tax return. Capital gains tax. When you sell a property at a profit, the gain is subject to capital gains tax. Currently, 50% of the capital gains amount is included in your income for tax purposes, and the remainder is tax-free. Primary residence properties, however, are exempt from capital gains tax. Goods and Services Tax, GST, Harmonized Sales Tax, HST. If you purchase a newly built or substantially renovated home, you may be required to pay the applicable GST, HST upon closing. Some rebates are available for rental properties, which can help offset these taxes. Land transfer tax. When purchasing a property, most provinces charge a land transfer tax based on a percentage of the property's value. Depending on the location, the tax rate can range from 0.5% to 2% of the purchase price. Property tax. As a property owner, you will need to pay annual property taxes to your local municipality. These taxes are determined based on the assessed value of your property and vary depending on your location and property type. To make the most out of your real estate investment and minimize the tax burden, keep the following strategies in mind. Claim deductible expenses. You can claim expenses related to your rental property, such as mortgage interest, property taxes, management fees, insurance, advertising, and maintenance costs, to help offset your rental income and reduce your taxable income. Utilize tax-deferred accounts. If you're investing in real estate investment trusts, REITs, or other real estate securities, you can hold these within a registered retirement savings plan, RRSP, or tax-free savings account, TFSA, to defer or eliminate taxes on your investment gains. Consider real estate limited partnerships. Real estate limited partnerships, RELPs, can provide investors with a way to pool their resources and invest in more significant real estate projects while receiving tax advantages. Offset capital gains. If you have realized capital loss from other investments, you can use these losses to offset the capital gains arising from your real estate investments and reduce your tax burden. Non-residents who invest in Canadian real estate also need to consider the tax implications of their investments. Here are a few key points to be aware of. Non-resident tax on rental income. Non-residents must pay a 25% tax on the gross rental income generated from their Canadian property. The tax is typically withheld at source by the property manager or tenant and remitted to the Canada Revenue Agency, CRA, on the non-resident's behalf. Filing a Canadian income tax return. Non-residents can choose to file a Canadian income tax return, allowing them to claim deductions against their rental income and potentially reduce their overall tax liability. Capital gains tax. Non-residents are also subject to capital gains tax when selling their Canadian investment property. They must notify the CRA within 10 days of the sale and pay the required tax on their gains. Foreign property reporting. Non-residents who own property in Canada may also need to consider the tax reporting requirements in their country of residence. Prior to investing in Canadian real estate, it's crucial for both residents and non-residents to fully understand the tax implications involved. Consult with a tax professional to help plan your real estate investment strategy and optimize your tax savings.